Welcome to DoubleLine's second annual Roundtable Prime, moderated by DoubleLine Deputy CEO Jeffrey Sherman. 5 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Roundtable Prime was recorded on January 5th, 2021, and will be divided into 3 segments: global macroeconomy, financial markets, and best ideas. Each segment will be released separately once a week for 3 weeks in January. The roundtable guests, all with decades of experience in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array of knowledge across different sectors of the financial markets, including fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator, and our host. Jeffrey Sherman will moderate today's discussions. Mr. Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests and was named one of the 10 must-listen podcasts by Business Insider in 2020. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 45 years, Ed has been ranked by Institutional Investor Poll of Investors for economics and ranked number 1 for 35 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equities, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIAZI Fixed Income Hall of Fame. Danielle DiMartino Booth. Danielle DiMartino Booth is CEO and Chief Strategist for Quill Intelligence, a research and analytics firm whose commentary appears in the Daily Feather and the Weekly Quill. Prior to Quill, she served throughout the credit crisis as advisor to Richard Fisher, president of the Federal Reserve Bank of Dallas. She is author of Fed Up, an insider's take on why the Fed is bad for America. David Rosenberg is president and chief economist and strategist of Rosenberg Research Associates, an economic consulting firm providing analysis and insights to investors. Prior to founding his firm, he was chief economist and strategist at Gluskin Sheff & Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analyst rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine, will now open the last of 3 segments of Roundtable Prime, Best Investment Ideas for 2021.
Okay, thank you for joining us for the last segment here of the second annual Roundtable Prime from DoubleLine. We're continuing our conversation today with the market leaders here. And what I really want to jump into is what are your best ideas for 2021? So let's go around the horn. Ed, let's start with you. Top of mind, best idea, thing you're thinking about, helpful to our viewers today.
So, I'm a business cycle analyst. That's what I do for a living. And in a situation like this, years past, I've always done like Caterpillar or Citibank or something like that. And I've stopped. Now I do tech stocks. I think that's the driving part and will be the driving part in 21. And so that's my favorite. part of the market. I'd also say that listening to Rosie, guys, he brings up a good point of diversification. And so I don't see how you can possibly be in this environment and not have some diversification. We haven't talked very much about real estate, but for most people, real estate is their biggest investment. And I'm bullish on real estate. But I also think that Rosie has a point that I have cash. And I like having cash because, like Jim Bianco pointed out, any little change in the climate, you could have a pretty big drop in the stock market. So I like cash, I like real estate, and I like tech stocks.
All right, simple 3-asset portfolio. I like it, Ed. Thank you. Rosie, to you, what are you thinking about?
Okay, well, I'm thinking about my favorite economic historians. So two of them being Adam Smith and David Ricardo, and thinking about investing around scarcity value. So I would say that what I want to have are maybe 4 major thematics around the theme of scarcity value. What is scarce? You want to invest in what is scarce, not what is abundant. I continue to say growth is scarce. I'm not bullish on the economy. I think that people that say, "Well, we're gonna go back to normal. We're gonna revert to normal." Well, remember what normal was the previous 10 years before the pandemic. It was the weakest economic expansion in the post-World War II era. So growth is scarce. Therefore, I prefer growth over value in the equity segment of the portfolio. Second, what is scarce? Well, obviously, I mentioned before, we all know $18 trillion of bonds trade with a negative yield. Some of that are corporates. So yield is scarce. So again, it means that I want to own income at a reasonable price. I think actually Jeff Gundlach said earlier that you could probably get that out of the equity market more than many segments of the corporate bond market. So I like especially with the dividend aristocrats underperforming so much this past year. I want to focus on dividend yield, and I want to focus on dividend growth, focus on where the payouts are going to be. I like the financials. I like the financials. Actually, we talked about energy or financials. Remember, energy, you're making a call on oil prices. What I like about the U.S. banks is they are, if you're going to play any recovery, their businesses are so diversified. Banks over energy. If you want energy, be tilted towards natural gas at least. But I like the banks. I love Canadian banks right now. Telecom, select REITs. Ed said real estate before. In a world where yield is scarce, I want recurring and reliable cash flow streams. The third, what else is scarce is safety. And that was the point I was making with Jim Bianco earlier, that I want to have safety in my asset mix. And I want to, because of my inflation view, of course, long duration, high quality bonds, even if it delays low yields, I want that in my portfolio. The fourth and final part that I want in my portfolio that's scarce is inexpensive assets. And so where are you going to get those? Well, when I think of inexpensive, I think of GARP, I think of growth at a reasonable price. I'm looking where assets are cheap. Again, it was mentioned earlier, Asia, China, Southeast Asia, where their price earnings multiples are actually equivalent to their long-term growth rates. So to that end, I'm saying that emerging markets, primarily in Asia, which is more growth than value, which is the emerging markets you'll get in Latin America. So my thematic has been invest where you can pick up inexpensive assets relative to growth rates. And so that theme has been go east, young man and young woman. So that's my final peg to that recommendation.
Yeah, we were looking at the sector CAPE ratios the other day, just as we turned the calendar, and notably that the only sector in the U.S. S&P 500 that is in the CAPE ratio is in the 20s is the financial sector. Everything is 30 or above today. And again, that doesn't take into account, obviously, pandemics with that long-term view, but just thought that was an interesting tidbit. So thanks for the recommendations, Rosie. Danielle.
I'm going to dovetail on what you were talking about. I do think that consolidation in the energy industry is going to be a big story in this coming year. And this is going to be really absent some kind of a huge spike in oil prices. I do think that there's enough insolvency risk going forward in the energy sector that the majors are going to continue picking off smaller players at a much cheaper price than they did in 14 and 15. And I'm also, we haven't talked about small and medium-sized banks' concentration in commercial real estate loans. That is not a part of the market that has necessarily been priced in. And I think that that is going to drive consolidation within the financials as well. So I think that those are two areas that you might not see fundamentals underpinning it, but you do see the cheapness of the acquisition targets as being a pivotal catalyst, I think, in the coming 12, 18 months. In the medium term, I think that silver has been beat up, and I would pile into silver in the medium term. And I think that as Charlie Evans says, if they're in it to win it, then you better own gold, and you need to be bold with the gold that you own. I agree that, I think that Greg Ip of the Wall Street Journal wrote one of the most seminal columns that came out in 2020, and that is, there was a very simple graph in there that showed that Huawei at the time owned 32% of all telecommunications equipment on planet Earth. And that if they got to 50%, just back the truck up. The United States has been focused on soybeans, while China has been focused on semiconductors and the next generation of growth. And if you want to talk about a country that has finally found corporate governance religion and finally cleaned up its balance sheets, any pullback in the markets, I would be focused, because Japan has had a good year. Jim pointed it out with the MSCI stats a few minutes ago. But any pullback in Japan, because they're going to be a beneficiary that, again, has cleaned up their balance sheets and has cleaned up, they're much less susceptible to corruption. I think that the Japanese market's going to be a very interesting one. It's a little bit rich right now, but I think it's going to be a winner long term based on where it is and what it's already come through since 1989 to today. So those are my three.
Yeah, one thing we're looking at was the new highs in the Nikkei. And the chart only went back 20 years or so, and it's like you're still like 30% off that 89 type of high. So, but that augurs for perhaps some room to run. So, Jim, I turn it to you. Best ideas.
Yeah, so I'm going to take the other side of Rosie's trade here about the financials. If the banks are a bunch of taxis, Uber's coming right at them right now, and that is the big four that have been performing tremendously within the financial sector. I've teased them a little bit in the previous section. Market access up 51% this year, 200% in the last 3 years. TradeWeb, which is another online platform to trade treasuries, up 35% in the last year and 134% in the last 3 years. MSCI, Morgan Stanley Capital Indexes, 75% return in the last year. S&P Global beat the S&P with a 22% return. The last two are helping you index and the big ESG movement. Now, the losers on this side is going to be the JP Morgans, the Goldman Sachs's, and the traditional banks. They've all got single-digit returns in the last 3 years. The bank index overall was down 13% last year, which is why your CAPE ratio for financials is so low. I think what we're doing is we're finding out that the large banks are utilities. So everybody works at a bank. I'm going to say something that's going to upset all my bank friends. Everybody works at a bank. Go to Glassdoor. Go look at what you get paid for at the electric utility, and now start slotting that in for your pay structure, because you're going to become a utility as well too. These new companies, the market accesses to TradeWebs, MSCI, S&P Globals, are going to take their business. Their trading businesses are going to go away to platforms. Their value-added business in terms of helping construct portfolios and putting together ESG and the like is going to go more to these businesses as well too. So within the financial sector, I think that disruption is going to continue as we move forward. A second idea for you, I happen to think that inflation is a bigger concern and so I want to play it directly and simply. I want to short the 10-year treasury. TBT is the ETF, or just short the 10-year treasury. I think yields are going to go up, and I think it's going to wind up being a good investment for it. Quickly, the third idea. We did mention briefly somewhere about central bank digital currencies. That's never going to happen. And the reason it's never going to happen is central bank puts together digital currency. They got to put together a platform in order to do something with it. That's a fancy way of saying you and me and everybody else, I can have an account with the Federal Reserve directly. I no longer need Wells Fargo, Bank of America, JP Morgan, or Citi. Their whole deposit business can go away with a central bank digital currency. If you're going to build a central bank digital currency and you're going to try and use a traditional bank as the front end, there's no point in building a central bank digital currency at that point. So while I think that digital currencies and cryptos are the future, maybe not Bitcoin, I'm not sure, I'll play the Coinbase IPO when it comes later this year. I think that at some point, I've likened this idea about what's happening with cryptos to the early part of search engines. Early on, if you go all the way back, we had Alta Vista, very first search engine, went out of business. Lycos went out of business. Then we had Yahoo. Yahoo was very successful, made the S&P 500, and then we got Google, and it changed everything. Maybe we're in the Lycos to, Yahoo kind of phase. Maybe Bitcoin goes away, maybe it doesn't, or maybe Ethereum or one of the stable coins takes over. Yeah, maybe so. But at some point, it's coming, and it's coming in a big way. And that is a cryptocurrency that will be a viable alternative to the dollar. It may not exist now, still might be 10 years away, but the basic way I want to play it is I don't want to pan for gold. I want to be the pick and shovel guy, and that's Coinbase. And that's why I think I'd be very interested in the Coinbase IPO when it comes later this year.
All right. I'm still an Ask Jeeves user, so it has now rebranded itself as Ask, so it's simpler to use. No one wants to type that much.
You're the guy. You're the guy.
Yeah, I'm the one guy still using it. Yeah. So anyway, with that, Jeffrey, why don't you close us out on your best ideas for 2021?
Well, I'll start with sort of a 40,000-foot overview. I think that we're not in Kansas anymore. And what I mean by that is we had an incredibly stable place that we were in that sort of ended around 2017 or 2018. We've seen multiple manifestations of that. For example, the VIX index in 2017 closed below 10 many days, blowing away any record. And we had the most stable risk asset market of all time. And I went on a TV show in July or August of 2017. And while I was being interviewed, the VIX crawler went by and it was at 9.85. And I said, my highest conviction idea is that the VIX index will soon be above 15, and we're going to go into a period of elevated volatility. What's funny about appearing on TV is I guess I get enough viewers that the show, after I appear, they have other guests comment on what I say, and they talk about what an idiot I am. So true to form, somebody comes on 2 hours after me and says, Gundlach's an idiot. He's got no idea that the VIX will never go above 15 again. There's structural changes in the market, and it'll be lucky if it can ever even poke its head above 10. And I have to laugh because it got above 15 the next day. It was just unbelievable. And I think that's ushered in a higher volatility environment. And I think we've been in a place of unnatural stability. We've exited that, I think, in terms of stock market volatility and credit market volatility, although presently it's stable for the short term. But I think we're going to be seeing increased volatility in inflation. Now, we've had inflation at 2% seemingly forever. Jim was right. You can win $1 or a beer at a bar if you bet somebody what the highest level of the core CPI has been since 1995, because no one believes it's a two-handle, but it is. But I think we have high deflationary risk because of all the debt in the economy. And I think the response to all this debt in the economy could be an engineered inflation, just like Volcker engineered disinflation. It can happen. So you have to be extremely diversified. And so I'm going to a basically 4-component portfolio that I've advocated since basically went into a lockdown economy. And that is 25% in long-term treasury bonds. And I think you're going to lose money on them, but you need them there for the deflation piece. And you want 25% in cash, which of course is a deflation asset. And then you want 25% in inflation hedge, be it Bitcoin or gold or real estate. I'm talking about real assets. I'm not sure I would buy Picassos right now but because of the elevated prices for the good ones, but I'm talking about real assets. And then finally, you want 25% in stocks. And based upon my view of the dollar and the valuations, I like Asian emerging market equities primarily. And if you're going to be in the United States, I think you want to be, I respect what Jim Bianco said, but I think you want to be in energy and in financials, but I would really favor foreign stocks to US because I think the dollar is going down. And so I think that portfolio put together got you through 2020 pretty well. And I think given the kind of fat tails that I anticipate in the next 3 to 4 years, I think you want to stay the course with that kind of safety portfolio barbell with inflation hedge risk. So that's where I am.
All right. Well, that was great. Any final thoughts that we didn't get out today around the horn? Anybody want to add anything that we missed? I mean, it was an inflation argument most of the day. Whether we have it, we won't. Anything that you want to have a parting words? Danielle, I'll start with you.
Well, I think what we should remember is the work that that Pat Toomey did to remove the ability of the Fed to simply revive from the dead pre-existing facilities that were deployed on March the 23rd, 2020. So I'll push back against the idea that there never will be a CBDC because it would put the banks out of business, Jim. You are absolutely correct. But if the Fed has to exercise 13.3, if the Fed has to exercise an emergency provision, as the new law is written, they have to come up with a new emergency. And they have to come up with a different sort of black swan in order to deploy shock and awe. And we forget what shock and awe felt like because most of the QE that was done inside of 3 months starting March. So, but in order for them to pull a sequel out, if need be, they really are going to have to do something completely different than what is anticipated. Again, if they're going to be able to access that emergency clause because of what Pat Toomey did in holding the line and in saying that the identical credit facilities couldn't just be brought back from the dead. So I think it is, again, something to watch closely because in desperate times, the Fed has been known to do crazy things.
Yeah. Ed, anything besides follow the money?
Well, the on the inflation topic, I wish we'd had more time to talk about the Roaring '20s. But the Roaring '20s was about one thing. You had zero inflation for a decade. 2021, 22, it was 1% in 1929. And what made that was technology. You had electricity, and then automation with the automobile companies and the radio, and so that's the inflation issue really is critical, like you highlighted. But from a practical point of view, if we get inflation, we'll see it coming, and we'll see, say, Jeffrey's 2.6 coming. And oil prices will go up to 100 and bond yields will go over 2%. And I'm positive that the Fed will stay on hold for a while. They won't react immediately. So I think that to the extent inflation does come, which I think is certainly plausible, I'll have 6 months or so to watch it before I have to really react to it. And I think the early phases of inflation will be viewed as good. No one ever got a pay increase they didn't think they deserved. And any price increase that companies get is because they finally got the product just right. And so the early phases of inflation are for an affirmation of excellence. And then you find out later that it's just a cheap drug and it's no good in the long run.
Okay. Rosie, I'll summarize you as don't discount deflationary based assets.
Well, look,
Anything else to add?
I'll just say pure arithmetic. We need to have 3 years of 4% GDP growth to get inflation. So I'm not saying we're never going to get it, but it's years away. That's just the math, unless you think GDP growth, and I don't think it's going to average 4% in the next 3 years. The Roaring 20s. We did not blow our brains out on fiscal stimulus. We just basically let the Spanish flu burn out, created tremendous tragedy, but we did not actually go through massive fiscal relief, quarter in, quarter out. Different society back then. We started the Roaring 20s with federal debt to GDP at 10%, not 100. Jeffrey Gundlach will say it's higher. Started at 10%, 10% debt GDP. Different society, different balance sheet, but what that allowed, and what made the Roaring 20s the Roaring 20s, and not just the fact that we actually had a supply side deflationary environment, that was very bullish. Started off at very low multiples, that was a nice launching pad. But because the federal balance sheet was in such great shape, corporate and personal taxes went down throughout the decade. That created the conditions. We're not going to be seeing lower taxes. I want to make this last point. People have Jenna Yellen completely wrong. I imagine there's people around here that think that they know her personally. I've met her, but I can't say I know her personally, but I know her record. And people think she's some sort of puffball, and she's going to work with Jay Powell, and there's going to be debt monetization, the debt jubilee, or helicopter money. That's not going to happen. There is not, and she was a Fed governor. She was head of the San Fran Fed. And then she was vice chair, and then she was chairperson. There is not a rate hike that was ever brought to the table, even during the Greenspan era, that she ever voted against. Not one. She was the first one in the last cycle, not Bernanke. Bernanke got scared away by the taper tantrum. She was the first one. She was the first one to raise rates and shrink the balance sheet. It was her. So people that think that, because they like to build the narrative that we got this Powell trade with Yellen and debt monetization, I would say it's a nice cocktail conversation. I would not put any faith in that view whatsoever. I don't see it happening.
Okay, with that, Mr. Bianco, any parting shots here?
Yeah, I'll just go back to my first comment and just reiterate it in regards to everything else we've been talking about. If you're going to keep mailing people money, and Rosie, you brought up the statistic I've been looking at, 20% of the American income comes from the government mailing it to you or direct depositing it in your account. And we just passed 900 billion, and we're talking about another 2,000. If there's no consequence, if all it does is give something to people and produce higher prices in asset markets because some of that money goes plowing into Robinhood accounts, we're going to do it again and again and again. And your wage inflation is going to be booming personal income via the government sending everybody money. It's going to be the same effect as big wages coming down the road. And that's where you're going to get the inflation. The only thing that's going to stop this, I think, is going to be an adverse outcome of some kind where people stand up and say, we got to stop doing this because bad things are happening. Right now, there's no bad things happening, so it's really hard to say stop doing it. It's just a theoretical argument that it will be bad things down the road, and you're just denying the poor the help that they desperately need right now. That's my biggest concern as we move forward from here, is the $2,000 check is going to beget another $2,000 check after that, which is going to beget more stuff after that until we get that adverse outcome.
So moral hazard risk, I think, is the best summary there.
Yeah.
And Jeffrey, why don't you take us home on this second annual Roundtable Prime?
Well, I really echo what Jim Bianco just said. I think that it's absolutely right that we're going to continue to have the same types of activities until there's real to be a downside to them. And it's like, I always use the analogy of the titration experiment, and put in it, and you take this other thing and you go drip, 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 drip. And the experiment is, when does the chemical reaction reach its turning point and you start to get light pink? in the beaker, and that's when you're right at the moment. And I always wanted to get straight A's, and so I was really careful. Drop, drop, drop. There were guys next to me that didn't care one bit, and they would just open up the stopper and comes in, turns blood red instantly. And that's kind of the problem with a policy that you feel somehow intuitively and academically that it doesn't lead you to the promised land. It might look good at first. Again, it's like the guy that jumps out of a 100-story building, and after not falling 90 floors, he goes so far, so good. But the outcome it's impossible, in my view, for it to end favorably. So you got to be diversified for that. There's high tail risk. You've got to asset allocate appropriately. And I'd just like to point out that my Buffalo Bills are finally a good football team. In fact, I might even say a great football team at this point. And it's great to see. So go Bills.
All right. Well, I think you'll get a lot of people echoing that here today. So I want to thank on behalf of DoubleLine and all of our clients, all of our guests today for spending time with us. You've been very supportive here. You've been appreciative with all your time, and we want to just thank you for the time you spent with us and providing your insights today. So we thank you for joining us for the second annual Roundtable Prime, and we look forward to continuing to read your research and sharing with our clients out there in the world today. So thanks again, everybody, for taking the time.